Hello and welcome to Watching the Tape. The good or bad thing about this video series is that you never know what you're going to get. And I would imagine there was an expectation that this week's topic would be all about the Fed's announcement on Wednesday. And while I am slightly to moderately obsessed with the Federal Reserve, we have a much different topic to cover this week, after I make a couple quick comments about the Fed news. So on Wednesday, the Fed announced a 50 basis point hike, and this was the first 50 basis point hike since 2000. All other rate hikes since then have been of the 25 basis point variety. And the stock market reacted very favorably on the day of the announcement. That was Wednesday, going up 3%. And it seemed that the stock bulls were really encouraged when Fed Chairman Jerome Powell indicated that a 75 basis point hike is not under consideration. So that was a bit of a relief for the investors who thought that the Fed may hike rates too quickly, too far, and thus push the economy into a recession. But by today, Thursday, investors seem to have collectively remembered all the bad things. Inflation is still very high. Interest rates are going higher. There's a war in Ukraine. China can't seem to stand back from its COVID lockdowns. Lots of bad things going on. The result, stocks fell more than 3% today. All right, let's move on to this week's subject. And it is something that is financial planning related. As you can imagine, as a financial advisor, the topic of investments and retirement planning comes up a lot when people meet me or among friends. And not too long ago, a friend, we'll call him Don Krogan, he asked me about retiring at age 60 with $2 million in his investment portfolio. Of course, a conversation ensued, and I really got to thinking that I wish I had our financial planning software handy so we could have walked through his balance sheet, his investment portfolio, his monthly budget, his retirement plans, etc. And so we use something called Right Capital, and it's a really neat tool. And what I'm going to do in this video is walk through sort of hypothetical, a very simple plan for this mystery man, Mr. Don Krogan, who is 54 years old today. So we're going to look at his balance sheet first, and that's what's on the screen here. We'll start at the top with $50,000 in his checking account. And as we go down this balance sheet, we're still on the asset side of it, right? There's $300,000 in a joint taxable investment account. There is $1.2 million in a 401k. So great job. These are not real numbers, by the way, but great job saving, hypothetical, and maxing out the 401k and just killing it on that front. As we go further down, his home is worth $750,000, against which there is a $200,000 mortgage. So the net of all that is that net worth is $2.1 million. Now remember, the question was, can I retire comfortably at age 60 with a $2 million investment portfolio? And if we go back up, the investment portfolio that we are considering here is at $1.5 million today. So 54 years old, he's got 5-6 more years to grow that wealth, contribute to it, and to get to $2 million. So remember that $2 million number as we move forward here. On the next screen, this is just a look at the budget annually. So year 2023, when Mr. Krogan is 55, let's say the salary is $150,000, his expenses amount to about $90,000, and you can click on expenses and see that there's $60,000 in living expenses, in addition to housing expenses of about $30,000, and that's just the mortgage payment. As we continue to go across, there's a tax payment, there's planned saving, and if you click on this, it is maxing out the 401k plus saving about $5,000 annually with after-tax dollars. And there is a little bit left over after all that, but we assume that that is spent. It's a small amount. So if we go to this next tab, it shows the invested asset. And this is the investment portfolio that we're talking about that should be at $2 million at retirement. So let's go down through the years to the year 2028. And that is when Mr. Don Krogan turns 60 and plans to retire. And the portfolio is about $2 million. So that is what's going to be the source of much of Don's income during retirement. All right, and the reason that grows is there's the maxing out the 401k, there's the 5,000 additional savings after-tax dollars, there's the employer match, and then there's portfolio return, which I assume to be sort of 3 to 4%. So nothing crazy, pretty conservative return estimates. All right, the next tab is going to show, this is a graphical representation of the sources of income for retirement. So at the bottom, age 60 is when he plans to retire, and the sources of income would be the orange, which is called savings withdrawal. That is drawing off of the portfolio. And then there's a blue piece here, which is pension. So let's assume he's got a small pension coming in. It's the company that he works for probably phased it out years ago, but there's a little bit of pension, in this case $20,000, that's going to grow about 3% per year in retirement. And then by about 65, 66, Social Security kicks in, and that is what this purple is here. So you've got Social Security, you've got pension, and you've got the withdrawal from the portfolio as the sources of income in retirement. Now, this last tab is where it gets really fun. And there's something called probability of success. And with all of these inputs and the assumptions about spending in retirement, there is a calculation made, probability of success. Right now it's at 88%. And ideally you want that to be 80% or higher. And so it's looking good right now. And what are the assumptions here? And this is, again, like I said, where it gets really fun, is expenses during retirement are expected to be $6,000 per month. And so this is away from housing and healthcare related expenses. So lifestyle expenditures of $6,000 a month. Well, let's say we want to change one of these assumptions. Let's say he gets burned out, wants to retire at 58. So let's change that to 58. What does that do to the probability of success in retirement? It drops it pretty significantly because that's 2 years of peak earnings that he is foregoing and instead drawing on the portfolio to fund retirement. So let's bring that back to 60. Let's say that he wants to spend a little bit more in retirement, so $6,500 per month in retirement. So that's a $6,000 extra per year that is being spent and not invested, and that drops the probability of success down to 72%. So still pretty good, but you can see how changing some of these assumptions can result in changing the probability of success in retirement. And again, this is a very, very brief introduction to our financial planning tool. There are countless other inputs and assumptions that we didn't even touch upon, like annual investment returns, inflation. Inflation is big. We can put in an assumption that inflation will be higher in future years, or maybe there's a goal to buy a vacation home. Does the client have real estate investment properties that are generating income? What do you think your spending profile is going to be in retirement? Are you going to be spending at the same rate at 65 that you will be at 85? Probably not. And there's ways to change those assumptions. So it goes on and on and on. There are lots of questions and assumptions that need to be addressed when building a financial plan. Regardless, the main takeaway from all this is that doing financial planning with a tool like Right Capital can really go a long way in helping you to get on track for retirement success. That's it for this week. We'll see you next week.